Good morning, investors and traders. Lee Lowell here, smartoptionseller.com. It is Saturday, April 18th, and it is morning time on East Coast hours. Hope everyone's doing well, staying safe, staying healthy. We've got another weekly video here for everyone. Been getting lots of questions about getting bullish here. Is it time to buy call options? Should we do it yet? Well, that's up to you. But what I wanted to do is have another video here showing you which is the best option strike to buy, in my opinion. I'm getting lots of questions. I still don't understand which option strike to buy. Which one should I buy? So I'll go a little in depth here today on a few different ways to buy call options and which ones I think are the best. So let's go to the charts. Let's see what happened this week in trading. I don't know if any of you are from New York, but you may have known Warner Wolf. Warner Wolf was a sportscaster on ABC TV, and he had his catchphrase, "Let's go to the videotape." So if any of you are old-time New Yorkers from the 1970s and 80s, you'd know Warner Wolf. So let's go to the charts. Let's see what happened this week before we get into the call option buying education. So as you know, if you've been watching my videos, I track the SPY, which is the exchange traded fund that represents the S&P 500. And it's a good barometer of the health of the overall market in general. So what we have here is, as I've been showing in previous videos, third week of February is when you know what hit the fan, and we started on this huge downtrend. And since March 23rd, when we hit the bottom here, we've just had this V-shaped recovery. I have the symbol here, the V shape. When you see a huge drop and then a huge bounce, it creates the V-shaped technical pattern here on the chart. And it's really hard for me to believe that with 22 million Americans filing for unemployment benefits just in the last month alone, that the market could recover so quickly, so fast. We're kind of just stuck here watching like a deer in headlights, that the market bounces so hard like that you can barely get on board even if you wanted to. So I have these lines on the charts, which are the moving averages, different moving averages. I've got the blue line is the fast 20-day moving average. The red line is the 50-day moving average. And this darker green line is the 200-day moving average. So with the bounce, right here, we're starting to bump up on the 50-day moving average. And this was at the close of yesterday. My previous videos, I thought we'd have some more resistance here on the 20-day moving average, which we did. We actually dropped for a couple days, and then we just blasted through. So now we're getting this resistance here on the 50-day moving average. I have to believe that, you know, we will either pull back or we'll just kind of meander along here. It's just the earnings results are starting to trickle out for the first quarter of 2020, and then the second quarter's earnings results will come out early July, mid-July. So it's hard to imagine that with all these people unemployed and all these businesses shutting down, that earnings results are not going to be good, and that should be reflected in the stock charts. So we've had the initial bounce, and let's see where we go from here. My gut is telling me that we will not go too much higher. We'll kind of meander around here or even drop if earnings results are really bad. But you never know. Maybe the drop was the drop was very panicky. Maybe it was just well overdone, and maybe this is where we should have only dropped to in the first place. This was probably about a 17 to 20% drop from the highs. So maybe this is where we should have been all along. And now we'll just kind of meander along. Anyone who got long down here did a great job. I've been buying in little bits and pieces on the way down and back on the way up. Not enough, though, to let me retire on a beach somewhere. So I'm still here. Anyway, so that's what's happening in the market. Let's take a look at the call option buying opportunities, because people have been emailing me telling me, when's it time to get in and which option strike should I buy? It's a big question. When you are trading options, it's more than what it takes to just buy a stock. When you buy a stock, you just buy the stock and that's it. When you're trading options, you've got direction, you've got timing, you've got volatility. All those things have to come into play together in order to really profit correctly when trading options. So there are specific strike prices that you should concentrate on that will give you a greater opportunity to make a profit. So which ones are those? Well, let's take a look at Disney. Now, I want to remind everyone, everything that we talk about here is for information and educational purposes only. No live trades here, no real recommendations, just showing this just for your education only. So we have a chart of Disney here. Disney closed at 106.63 on Friday. Nice big drop. And we've got the bounce here just like everything else. Didn't bounce as hard as some of the other stocks. But if you're thinking that Disney is ripe to get bullish for long term and you want to get on board, what can you do? Well, other than just buying shares of Disney, which you can actually do, how can you use call options to your benefit, and which call options should you buy? Now, just remember, if you want to get into the stock market, and I go on a long-term perspective, so you want to get in for the long haul. We're not day traders here. We're not really even swing traders. We want to get in for the long haul. So if Disney is something that a company that you're gung-ho on for the long haul, you want to have a long-term perspective. I'm talking at least 6 months in length, okay? So Disney's at $106.63 per share. You want to get long for the long term because you think it's going back up. Which strike should you buy? Well, let's go to our option chains. Interactive Brokers is the broker that I use, and many of you use as well. This is their option chain, options trader screen right here. I've got Disney pulled up on the top here. This gives me calls on the left, puts on the right, and I'm looking at the October 16th, 2020 expiration date, this tab right here. That's 6 months in the future, okay? So we're looking long term. Which strike should you buy? Well, if you've been reading some of my blog posts and watching some of these other videos, you know that I'm a huge fan of buying deep in the money call options. Why deep in the money call options? Because deep in the money call options give you lots of bang for your buck. That option, that call option, will move almost in lockstep with the stock movement. That's what you want. You want your option. When you buy an option, you want it to move, right? So that means you have to concentrate on buying high delta options. And high delta options are synonymous with deep in the money options. What makes a call option deep in the money? Well, its strike price is set well below the current price of the stock. Here's Disney, last $106.60. A strike price who's situated well below that stock price is called deep in the money. These 75 calls right here has a delta of 87.5. Now, when we talk about deep in the money options, deep in the money call options, we want at least a 90% delta. Yes, if you've been reading some of my information, you know that I talk about buying call options with at least a 90% delta. So let's look at the 70 strike. Go over to the delta column. There, meets our requirement. It's got a 90.4% delta. That's good. That's what we want to concentrate on. So that is one of the first strikes that we will look at. Now, that option will cost you. You have to look at the bid and ask. That's how much it will cost you to either buy or sell it. And you always want to go somewhere in between the bid and ask prices. So fair value is roughly $39 per contract for that option. Okay. Now, you can also go and look at the at the money options. What are at the money options? At the money options are strike prices that closely resemble the current stock price. So if Disney's at $106 a share, you concentrate on the $105 strike because that's as close to the current price of the stock as you can get. And typically, those deltas are around 50-something%. In this case, the 105 call, which is very slightly in the money, has a 57.5% delta, and its price is roughly $1,260 per contract. And that means it's $1,260 actual dollars. The 70 call that we looked at, if the fair value was $39 a contract, that means it's a $3,900 investment. The 105 calls are a $1,260 investment. Now, let's say if that was too rich for you, didn't want to spend all that money. You can look at the $155 call option. What will that cost you? A good 82 cents per contract, which is 82 actual dollars. So your choices are, you can either spend $82 $1,260 or $3,900 for various call options. Which one do you choose? Well, people always say to me, Lee, why don't I just buy the cheapest call option on the board? I only want to spend a few dollars. You can certainly do that, but you know what? You're not going to make any money on those options because Disney will have to travel very, very far in order for those options to pay off. What do you mean by that? Well, you have to take into consideration how far Disney needs to travel and what are the chances of it getting to that point in order for you to profit. Now, let's say you chose the $55 call options for 82 cents a contract. Well, Disney has to move up to and above $155 per share by October from its current price of $106 before you even consider making any money on that trade. If you hold the option to expiration, which most people do, what are the chances of Disney going from $106 all the way above $155 by October? Well, nobody knows. You don't know where Disney's going to go. Why take the gamble for Disney having to travel that far in order for you to make any kind of money? That is a dumb play in my opinion. But everyone to each their own. If you want to make a spec trade like that, you can do it. Here's a few things that'll help you decide which is the best option to choose. Now, what we want to do is we want to go to our probability calculator. You may have seen me use this before. Probability calculator tells us what are the chances of a stock moving to a certain price by a certain date. It will give you the probability of that based on all the current parameters of the stock at that time. It's a great little tool that'll give you an idea of how successful your trade may or may not be. So what you see in front of you is a probability calculator. Now what I've done is I put in some of the input numbers. This is the input section up top, and then the output section is down here. What this will tell you what your chances are of Disney going from $106.63 per share all the way up to your break even of $155.82 if you bought that 155 call option. What it tells you is that you only have an 8.9% chance of Disney moving that far within the time allotted. Now let's look at the 105 calls, which cost $1,260. That break even would be $117.60, right? Let's get your strike price plus the cost of the call, add them together, and that's your break even. Your break even, 36.4%, bit better, okay? Disney has to go up from 106 all the way to 117 by October. You got a 36.4% chance, not too bad. What if we bought the $70 call option for $39 a contract? That makes our break even $109. And that would give us a 46.9% chance of getting above our break even, right? That's what you want to do. You want to get as close to the break even of the stock as possible. Disney's at 106.63 right now. What are the chances of it getting and staying at break even? It's got to be 50%, right? If you buy a stock, you either go up or you go down right from the moment you buy it. There you go. Got a 50-50 chance of succeeding. So you want to buy a call option that has the closest break even to the stock. That'll give you the best opportunity. In this case, that's buying the $70 call option. On this page, I've broken it all down for you. Basically, it tells you what the cost of buying 100 shares of Disney would be. Buying the $70 call, what the delta, your cost, your break even, your probability, all three opportunities. So you can go back and watch this chart and pause it later if you want. But to get the best bang for your buck, you want to buy the deep in the money call options. Your break evens will be better, and you have a better opportunity to make a profit on the trade. Okay, so there you have it. The three opportunities to buy and call options. You got the deep in the money, at the money, and the out of the money. Which one's best? You know my opinion, the deep in the money call option. If you go to our website and you want a little bit more in depth on how the deep in the money works, I've got this report that I wrote, How to Buy Warren Buffett for Pennies on the Dollar. Definitely a good eye-opener in buying the deep in the money call options. If you want more information on our website, some of the things we offer, click on the services tab. You'll see what we can do. That's all for today. This is Lee Lowell signing off.